Hello everyone, and thanks for watching Edupedia World videos. In this chapter, we will attempt to answer this question: what do economists study? So, we will see how the subject is divided up, and in particular, we will start with an introduction, then we will define scarcity, demand, and supply. After that, we will distinguish between the two major branches of economics, which are macroeconomics and microeconomics. Finally, we will see the circular flow of goods and services. So, let's get started. In fact, many people think that economics is about money. Well, to some extent, this is true. Economics has a lot to do with money. With how much money people earn, how much they spend, what various items cost, how much money firms make, the total amount of money there is in the economy. But, as we will see later in this course, money is only important because of what it allows us to do. That is to say, money is a tool, and economics is more than just the study of money. It is concerned with the following: the production of goods and services, how much the economy produces, both in total and of individual items, how much each firm or person produces, what techniques of production are used, how many people are employed. And we said that economics is also concerned with the consumption of goods and services. That means how much the population spends and how much it saves, what the pattern of consumption is in the economy, how much people buy of particular items, what individuals choose to buy, how consumption is affected by prices, advertising, fashion, and other factors. But we still have not got to the bottom of what economics is about. What is the crucial ingredient that makes a problem an economic one? The answer is that there is one central problem faced by all individuals and all societies, and from this one problem stem all other economic problems. This central economic problem is the problem of scarcity. This applies to all countries of the world, no matter how rich. For an economist, scarcity has a very specific definition. In fact, scarcity is the excess of human wants over what can actually be produced to fulfill these wants. Ask people if they would like more money, and the vast majority would answer yes. They do not want more money for its own sake, but to enable them to buy more goods and services. It's a tool, yes. These wants will vary according to income levels and tastes. In a poor country, wants might include clean water, secondary education, and secure housing. In richer nations, wants might involve a second car, longer holidays, and more time to spend with friends and family. The point is that even as countries get richer, human wants are virtually unlimited. Yet, the means of fulfilling these wants are limited. At any point, the world can only produce a limited amount of goods and services. This is because the world only has a limited amount of resources. These resources, or factors of production as they are often called, are of the three broad types. And we will see in details these resources later. But let me say that the types of factors of production are as follows. We have the human resources, or labor. The labor force is limited in number but also in skills. and this limits the productivity of labor. We also have the natural resources, which are the land and raw materials. The world's land area is limited, as are its raw materials. And finally, we have the manufactured resources, or capital. Capital consists of all those inputs that have themselves had to be produced. The world has a limited stock of factories, machines, transportation, and other equipment. The productivity of this capital is limited by the current state of technology. So this is the fundamental economic problem. Human wants are virtually unlimited, whereas the resources available to satisfy these wants are limited. We can thus define scarcity as follows. Scarcity is the excess of human wants over what can actually be produced. Because of scarcity, various choices have to be made between alternatives. Of course, we do not all face the problem of scarcity to the same degree. A poor family, unable to afford enough to eat or a decent place to live, will hardly see it as a problem that a rich family cannot afford a second skiing holiday. But economists do not claim that we all face an equal problem of scarcity. In fact, this is one of the major issues economists study: how resources are distributed, whether between different individuals, different regions of a country, or different countries of the world. This economic problem, limited resources but limitless wants, makes people, both rich and poor, behave in certain ways. Economics studies that behavior. It studies people at work, producing the goods that people want. It studies people as consumers, buying the goods that they themselves want. It studies governments influencing the level and pattern of production and consumption. In short, let me say that economics studies anything to do with the process of satisfying human wants. Let's talk about demand and supply. Briefly, of course. We said that economics is concerned with the consumption and the production. Another way of looking at this is in terms of demand and supply. In fact, demand and supply and the relationship between them lie at the very center of economics. But what do we mean by the terms and what is their relationship with the problem of scarcity? Demand is related to wants. If goods and services were free, people would simply demand whatever they wanted. In total, such wants are likely to be virtually boundless, perhaps only limited by people's imagination. Supply, on the other hand, is limited. It is related to resources. The amount that firms can supply depends on the resources and technology available. So, given the problem of scarcity, given that human wants exceed what can actually be produced, potential demands will exceed potential supplies. Society, therefore, has to find some way of dealing with this problem, to try to match demand with supply. This applies at the level of the economy overall. Aggregate demand will need to be balanced against aggregate supply. In other words, total spending in the economy should balance total production. It also applies at the level of individual goods and services. The demand and supply of cabbages should balance, and so should the demand and supply of digital cameras, cars, houses, and packaging holidays. But if potential demand exceed potential supply, how are actual demand and supply to be made equal? Either demand has to be reduced, or supply has to be increased, or a combination of the two. So economics studies this process. It studies how demand adjusts to available supplies and how supply adjusts to consumer demands. Well, now let's talk about dividing up the subject. In fact, economics is traditionally divided into two main branches, macroeconomics and microeconomics, where macroeconomics is defined as follows. It is the branch of economics that studies economic aggregates. For example, the overall level of prices, output, and employment in the economy. In fact, macro comes from Greek word makros, meaning large. So it is the study of the economy as a whole, and let me say that it focuses on big picture and ignores fine details. Macroeconomics is concerned with the economy as a whole. It is thus concerned with aggregate demand and aggregate supply. But aggregate demand, we mean the total amount of spending in the economy, whether by consumers, by customers outside the country of our exports, by the government, or by firms when they buy capital equipment or stock up on raw materials. And by aggregate supply, we mean the total national output of goods and services. As for microeconomics, it is the branch of economics that studies individual wants, units, for example, households, firms, and industries. Micro comes from Greek word mikros, meaning small, and it is the study of behavior of individual households, firms, and governments. In brief, microeconomics is concerned with the individual parts of the economy. It is concerned with the demand and supply of particular goods, services, and resources such as cars, butter, clothes, haircuts, plumbers, accountants, blast furnaces, computers, and oil. Now, we will talk about a new and very important concept called the circular flow of goods and incomes. In fact, the process of satisfying human wants involves producers and consumers, or households and businesses. The relationship between them is two-sided and can be represented in the following flow diagram. The consumers of goods and services are labeled households. Some members of households, of course, are also workers, and in some cases are the owners of other factors of production too, such as land. The producers of goods and services are labeled firms or businesses. Firms and households are in a twin demand and supply relationship with each other. First, in the bottom part of the diagram, households demand goods and services, and firms supply goods and services. In the process, exchange takes place. In a money economy, firms exchange goods and services for money, as opposed to a barter economy. In other words, money flows from households to firms in the form of consumer expenditure, while goods and services flow the other way, from firms to households. This coming together of buyers and sellers is known as a market. It could be a street market, a shop, or a website offering online shopping. Thus, we talk about the market for apples, for oils, for houses, for televisions, and so on. Second, firms or businesses and households come together in the market for factors of production. This is illustrated in the top half of the diagram. This time, the demand and supply roles are reversed. Firms or businesses demand the use of factors of production owned by households, which are labor, land, and capital. Households supply them. Thus, the services of labor and other factors flow from households to firms, and in exchange, firms pay households money, namely wages, rent, dividends, and interest. Just as we refer to particular goods market, so we can also refer to particular factor markets. The market for bricklayers, for footballers, for land, and so on. There is thus a circular flow of incomes. Households earn incomes from businesses, and businesses earn incomes from households. The money circulates. There is also a circular flow of goods and services, but in the opposite direction. As households supply factor services to businesses, which then use them to supply goods and services to households. This flow diagram, like the production possibility curve that we will see later, can help us to distinguish between microeconomics and macroeconomics. Indeed, microeconomics is concerned with the composition of the circular flow. What combinations of goods make up the goods flow? How the various factors of production are combined to produce these goods, for whom the wages, dividends, rent, and interest are paid out. Macroeconomics is concerned with the total size of the flow and what causes it to expand and contract. Eventually, let me sum up what we have already saw. In fact, we saw that the central economic problem is that of scarcity. Given that there is a limited supply of factors of production, labor, land, and capital, it is impossible to provide everybody with everything they want. Potential demands exceed potential supplies. 2. The subject of economics is usually divided into two main branches, macroeconomics and microeconomics. Macroeconomics deals with aggregates such as the overall levels of unemployment, output, growth, and prices in the economy. Microeconomics deals with the activities of individual units within the economy, firms, industries, consumers, workers, and so on. Because resources are scarce, people have to make choices. Society has to choose by some means or other what goods and services to produce, how to produce them, and for whom to produce them. Microeconomics studies these choices. Eventually, we saw that the circular flow of goods and services shows the interrelationships between businesses and households in a money economy. Firms and households come together in markets. So in goods markets, businesses supply goods and households demand goods. In the process, money flows from households to firms in return for the goods and services that the firms supply. In factor markets, firms demand factors of production and households supply them. In the process, money flows from firms to households in return for the services of the factors that households supply. Well, this is the end of the present chapter. Thank you very much for your attention. The next chapter will be entitled and related to different economic systems.